Hi friends, welcome back to Murthy Finance Academy. Today we will be discussing one interesting player from solar energy sector. The company is none other than Premier Energies Limited. So in Q3 fiscal year 2026, the company's revenue up by 13.202%, EBITDA surging 382%, and PAT rocketing 811% year on year as the TOPCon pivot transforms unit economics into institutional grade returns. Operational delivery is clinical. The 400 megawatt or 350 megawatt expansion is live, and the flagship G12R line is already hitting 80% utilization ahead of its February peak. The billion-dollar question is, can Premier scale to 10 gigawatt and integrate backward into wafers to escape the Chinese commodity trap, or will the 5,900 crore capex break the balance sheet? So, Premier Energies is no longer a bit player. It is the strategic pivot point for India's energy independence. As the government weaponizes policy via ALLM2, private rooftop or open access, and ALLM3, wafers, the market is entering a violent shakeout. While giants like Wari and Adani boast massive announced scale and Goldie Solar attempts to consolidate, Premier has achieved first mover status in TOPCon technology. The so what is the divergence between paper capacity and operational throughput. India has 200 gigawatt of announced capacity, but barely 30 gigawatt is operational cell capacity. Premier's ability to run high efficiency lines in a market structurally short of cells creates a massive barrier to entry. We are at a 7 gigawatt capacity inflection point that moves this company from a manufacturer to a dominant industrial force. So the company incorporated in 1995 and headquartered in Hyderabad, Premier Energies has evolved into India's apex solar cell exporter. At a market cap of nearly 32,780 crores, the company effectively owns 100% of India's solar cell exports, a proof of quality that precedes domestic protectionism. The roadmap is aggressive, scaling to 10.6 gigawatt cell and 11.1 gigawatt module capacity by fiscal year 2028. While the stock has seen a 23% correction in 1 year trajectory, this is a classic listing divergence. The company market is pricing in a commodity cyclicality, ignoring a 50% plus ROE and record profit growth. So, Premier Energy's moat is built on technical grit, running TOPCon lines at 25.2% plus efficiency while targeting is 25.8% involves a steep learning curve that kills competitors' margins during the 18-month stabilization phase. Premier stabilized it in 6. By dominating the export market, they have battle tested their tech against global benchmarks, creating a technical wall that local assemblies simply cannot scale. The consensus is treating solar as a volume game. They are wrong. The real compounding math lies in the efficiency spread. By moving from mono PERC to TOPCon, Premier captures three levers: volume, 7 gigawatt add on, mix, high margin G12R, and margin, operating leverage. The market is missing the G12R technical wall. Chiranjeev Sauluja has been blunt. M10 wafer sizes are becoming uneconomical. While competitors are stuck with depreciating M10 lines, Premier's G12R shift aligns them with the new global standard. This isn't just growth, it's a technical land grab that secures dominant free cash flow before the domestic industry even finishes its pilot runs. So the Indian solar landscape is a vacuum waiting to be filled. Government tailwinds like PM Suryagar, 10 million homes, and the phased out rollout of ALLM 2 and 3 ensuring demand will remain structurally short for years. Specifically, ALLM 2 is the immediate driver for the 30 gigawatt plus DCR market in fiscal year 2027. Crucially, China's anti-involution policy, effectively a price floor for their own manufacturers, acts as a global margin buffer for Indian players. In this environment, the only risk is execution, not demand. So, coming to its cells, its DCR realizations are at 0.14 to 0.145. This is the core engine of the integrated margin. Coming to modules DCR, premier realization is at 0.23 to 0.24, protected by mandatory local content rules. Coming to modules of non-DCR, commodity pass-through at 0.165 to 0.17, primarily a volume filler for utilization. Coming to transformers, the new 1000 crore top line engine by fiscal year 2028, pivoting to high margin EHV segments. Coming to inverters with K Solar, strategic vertical integration to capture the full residential rooftop profit pool. And coming to aluminum frames, a 260 crore capex to break the anodizing bottleneck by December 2026. Coming to BESS, it's 6 gigawatt per phase cell to pack line, providing high margin grid balancing solutions. Coming to ingot-wafer integration, the 5,900 crore ALLM3 play capture the final upstream profit pool. So revenue of 5% quarter on growth looks lumpy due to site readiness. Higher non-DCR sales this quarter temporarily suppressed revenue but protected integrated margins. Margins with a robust 31% OPM, silver consumption, the primary cost headache is 6 months hedge with a technical path to a 30% reduction in consumption. Coming to balance sheet, it's 1622 crore borrowings versus 3409 crore reserves as of September 2025. The 1348 crore OCF of March 2025 proves this as a cash generating machine, not a capex black hole. RPTs, the Helios Anthos acquisition isn't just a related party deal. It gives Premier 51% control of its supply chain by the end of March 2026. So Premier Energy's earnings are high quality. A 53.6% ROE and a drop in debtor days from 71 to 45 are the ultimate proof of bargaining power. They aren't chasing customers. Customers are paying upfront to secure a spot in the cell production queue. So coming to some con call highlights, the company's lines are running at best in industry utilization. So they are sold out for 15 plus months. Every incremental megawatt is now pure operating leverage. So M10 is becoming uneconomical. So here management is aggressively making competitors tech obsolete. And company's efficiency is also hitting 25.8% by end of year. It means global tier performance that eliminates the Chinese quality argument. And the company is waiting for ALLM3 for the wafer plant. So this is disciplined capital allocation. They won't pull the 5,009 crore trigger until the policy moat is guaranteed. And the silver consumption is also getting reduction of 30%. It means protecting the 30% OPM via engineering, not just financial heading. So management hit the 80% TOPCon utilization rate ahead of schedule and delivered the 400 megawatt expansion at a remarkably low capex of 101 crore. They are consistently under promising and over delivering. Saluja and Rustagi are operating with a level of technical precision that makes this feel more like an energy tech company than a traditional manufacturer. They are moving faster than the policy environment, which is the hallmark of a first mover. So coming to its order book, it is at nearly 13,723 crores, which is showing 75% revenue visibility for the next 12 months. And its capacity utilization is for 90% for cell and 80% for module, peak industrial levels. And ROE is around 53.6% and ROCE at 41.1%. And debtor days also reached to 45, down from 71. This is the bargaining power KPI. Solar cells are currently a seller's market. So coming to its valuation, at a PE of nearly 24.6, Premier trades at a discount to specialty peers like APAR, which is trading at 42. The market is pricing this as a commodity play. The financials suggest a technological ladder. So in a bear case scenario, if ALLM3 stalls, silver spikes to more than $30 per ounce, multiple compression to 15 times. In a base case scenario, if 7 gigawatt commissioned by September 2026 plus 30% operating margin, then the current price is an attractive entry. In a bull case scenario, if successful wafer integration plus US export breakthrough, then a significant re-rating as an integrated energy plant. So at 24 times of earnings, you aren't paying for perfection, you are paying for a 10 gigawatt plan that is already 80% built. The integrated margin provides a floor that module only players don't have. So what are some key risks? It is nothing but first one is technical obsolescence. If HJT skips TOPCon faster than the 5-year depreciation cycle, the efficiency moat thins. Silver risk. A 1 cent increase in silver prices without a pass through translates to a 5.5% hit to segment EBITDA. And third is RPT scrutiny. Helios, Santos, and Transcon payments must be monitored to ensure cash is staying within the ecosystem for growth, not leakage. So, what are the some key monitorables which you need to track is in March 2026 whether commissioning of the 5.6 gigawatt module line, and in June 2026 whether the commissioning of the 4.8 gigawatt cell line, which is the ALLM2 trigger, and ALLM3 announcement, the final green light for the Naidupeta Ingot-wafer plant. And the fourth is silver consumption, whether hitting the 20 mega mg per cell target via zero bush bar technology. And the last is Transcon GVA reaching 16.75 GVA capacity by July 2026. So what is the verdict for this company? The bull case for premium energies is anchored in a technical reality the market hasn't fully digested. They are the only Indian player successfully manufacturing G12 or TOPCon cells at scale with 25% plus efficiency. That 53% ROE and shrinking debt cycle prove this as a high barrier business, not a commodity treadmill. While the 5,900 crore Naidupeta wafer plant carries execution risk, it is the final piece of the ALLM fortress that will insulate them from Chinese volatility forever. At the current multiple, the market is giving you the execution risk for free by the execution. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.